One big reason the dollar's been sliding is because foreign investors are starting to lose confidence in the U.S. economy.
The cracks in the system are widening, and the whole world is paying attention. China is no longer moving quietly in the background. It's taking deliberate, high-impact steps that strike at the heart of America's financial dominance. For decades, Washington behaved as if the U.S. dollar would always sit at the center of global trade and security, beyond challenge or competition. Today, that certainty is fading. China is steadily offloading U.S. debt, buying up massive amounts of gold, and building alliances with governments that are tired of operating under American rules. These are not distant plans on a policy paper. They're actions already reshaping global finance.
Some of the biggest dollar moves we've seen for decades as these asset allocation shifts get in motion. People reducing U.S. exposure.
What you won't hear from mainstream headlines is how unsettled Washington and Wall Street have become. In private, policymakers are scrambling for answers, investors are moving their money, and ordinary citizens remain largely unaware while the global chessboard is being rearranged. Each step Beijing takes reverberates through stock markets, through boardrooms, through household budgets, touching savings, jobs, and the cost of living. Treating this as a routine trade squabble misses the scale of what's underway. This is a contest over financial power, and at the moment, the momentum favors China. So buckle up. In this video, we'll break down how America is gradually losing its grip, how China is building strength, and what those shifts mean for your wallet, your investments, and your future. By the end, you'll see why the dollar in your hand no longer carries the same level of security people once took for granted. If you're new to the channel, make sure to subscribe now. The information we're about to unpack is the kind of insight powerful players prefer to keep out of the public eye. Let's get started. Let's take a closer look at what's happening right now. China has been steadily cutting back its holdings of U.S. Treasuries, and the pace is striking. In July, their portfolio dropped to about $730 billion, down roughly $26 billion in a single month. That's the lowest level since 2009. For perspective, in 2013, China held close to $1.3 trillion in treasuries. In just over a decade, that stockpile has been cut almost in half. Moves of this scale are not made on impulse. Selling down hundreds of billions reflects deliberate long-term strategy. Treasuries sit at the heart of America's financial system. Government bonds used to finance federal spending and underpin the dollar's role as the world's most trusted currency. That trust depends on steady demand from large foreign buyers. When they step back, confidence in that foundation begins to erode, and the bigger picture is sobering. U.S. public debt has already climbed beyond $37 trillion, growing larger every day. Servicing it requires a constant flow of outside money. Yet China is pulling away, Japan has been reducing its exposure as well, and countries in the Middle East are increasingly settling trade in Chinese yuan. Each of these shifts adds pressure to the U.S. bond market. If foreign appetite dries up, the gap will have to be filled by domestic banks or the Federal Reserve itself, effectively America borrowing from within. That usually means higher borrowing costs, more inflationary pressure, and weaker confidence in the dollar. The question is unavoidable. If fewer countries are willing to finance Washington's borrowing, who will step in? And if no one can replace that demand, how long can the U.S. keep running its finances at this scale without serious consequences? These aren't abstract policy debates. They affect mortgage rates, retirement savings, and the price of everyday goods. To understand where this pressure is coming from, we need to look at China's reasoning. Their retreat from U.S. Treasuries is not about short-term profit or market timing. It's about long-term survival. For years, Chinese policymakers have warned that the dollar serves as more than a currency. It can be wielded as a weapon. That warning came into sharp focus in 2022, when Washington froze Russia's foreign reserves after the war in Ukraine began. Overnight, hundreds of billions that Moscow assumed were secure became unreachable. For the U.S., it was punishment. For Beijing, it was a warning. Chinese leaders imagined a similar scenario. What if a conflict erupted over Taiwan, and nearly $1 trillion in U.S. assets suddenly became untouchable? That risk was too high. So the response was gradual but deliberate. Beijing began reducing its treasury holdings and redirecting reserves into assets that Washington cannot control. Gold has become the centerpiece of this strategy. Unlike dollar-based assets, gold can't be frozen by sanctions or blocked by financial institutions. By steadily adding to its reserves, China is building protection against financial pressure from Washington. Alongside this, some diversification has gone into other reserve currencies like the euro, the pound, and the Swiss franc, still liquid, but less exposed to US policy decisions. For the United States, this shift is happening at a time of maximum vulnerability. With the national debt now above $37 trillion, America depends on global demand to keep its borrowing affordable. If major foreign holders step back, Washington is forced to rely more on domestic banks or the Federal Reserve, leading to higher interest costs, more money printing, and rising costs for households. Early signs of this pressure are already visible. Treasury auctions have needed higher yields to attract buyers. Inflation remains above the Federal Reserve's comfort zone, and the BRICS bloc is building new trade systems that bypass the dollar entirely. Step by step, the financial order is adjusting to a world where treasuries and the dollar no longer sit unchallenged at the center. While Wall Street celebrates new highs, the real economy is telling a different story. The labor market, once a reliable pillar of strength, is now showing signs of fatigue. In August, the US added only 22,000 jobs, far below expectations. The unemployment rate rose to 4.3%, the highest since late 2021. Earlier figures were revised downward, revealing hidden weakness. June, for example, flipped from reported gains to a loss of 13,000 jobs. Key sectors like manufacturing, construction, and professional services are beginning to cut back, hinting at a broader slowdown. If these trends persist, the impact will spread quickly. When hiring stalls and layoffs increase, consumer spending, the backbone of the US economy, tends to shrink. Leaders in finance are already voicing concern. Larry Fink, CEO of BlackRock, warned the economy is weakening as we speak, pointing to declines across industries and a pullback in household demand. JP Morgan's Jamie Dimon has been just as blunt, putting recession odds at about 50-50 and cautioning about risks in the private credit market, where high leverage is building fragility. Recent numbers support those warnings. The first quarter of 2025 saw an unexpected contraction of 0.3%, the first decline since 2022. And looking ahead, the OECD projects US growth slowing to 1.8% in 2025 and further to 1.5% in 2026, weighed down by tariffs, weaker global demand, and tighter financial conditions. Yet on the surface, markets seem unstoppable. The S&P 500 has hit 25 record highs in just 3 months, with returns pushing well into double digits for the year. But that rally sits on shaky ground. This is the contradiction the US faces. Stock markets keep rallying, but the fundamentals beneath them look fragile. Investors are betting weak data will force the Federal Reserve to cut rates, and those expectations are keeping valuations afloat. But if inflation refuses to ease, if job losses deepen, or if earnings falter, those bets could unravel fast. The cracks in America's economy are clear, and Beijing is watching closely. As China reduces its exposure to US debt, it isn't simply holding cash on the sidelines. Instead, Beijing is redirecting its reserves toward Europe, where the financial system offers both size and stability. The euro remains the second most important reserve currency in the world, and the European Union is still China's largest trading partner. In 2023, trade between the two reached nearly 860 billion euros, according to Eurostat. With so much commerce already flowing in euros, it makes strategic sense for China to hold more of that currency in its reserves, rather than relying heavily on the dollar. The United Kingdom plays a different role in this strategy. Even after Brexit, London has held on to its status as one of the world's most influential financial hubs. Chinese banks and technology firms continue to use the city as a gateway into European markets. Earlier this year, the London Stock Exchange expanded its Shanghai London Stock Connect, giving Chinese companies more direct access to British capital. For Beijing, sterling assets are a smaller piece of the puzzle than euros, but they add another layer of diversification and a bridge into Western markets. And then there's Switzerland, a country with a reputation that looms far larger than its size. The Swiss franc has long been seen as a classic crisis currency, the place investors flock when global tensions rise. Even in 2024, when the franc hit multi-year highs, global capital still poured into Swiss assets. The attraction is straightforward. The Swiss National Bank follows a conservative approach. Swiss politics are stable and neutral, and the banking system is regarded as one of the most secure in the world. For China, building a position in Swiss assets is less about chasing returns and more about creating protection against shocks, whether those shocks come from markets or geopolitics. By spreading reserves across euros, pounds, and francs, Beijing is doing more than just hedging risk. It is signaling to the world that U.S. Treasuries are no longer the only dependable option for global reserves. That shift in perception may be just as consequential as the actual flow of money, because once other governments begin to believe there are alternatives to the dollar, the old financial order starts to loosen. And the impact of that shift is being felt most clearly where it matters most, inside America's own debt market. The U.S. Treasury market is the engine that keeps Washington's finances running. To cover its massive deficits, which are now running above $2 trillion every year, the Treasury holds around 300 bond auctions annually. These auctions are the real test of global confidence, because they show whether investors are still willing to finance America's debt on favorable terms. Lately, the signals coming out of these auctions have grown far less reassuring. One measure closely watched by traders is the bid-to-cover ratio. It tells you how many dollars of demand are chasing each dollar of bonds on offer. Strong auctions attract plenty of bids, signaling comfort with U.S. debt. But in recent months, that cushion has thinned. In August, a 30-year bond auction cleared with one of the weakest bid-to-cover ratios since 2011, according to Bloomberg. For a country issuing record volumes of debt, that kind of result is unsettling. Another sign of strain comes from the so-called auction tail, the gap between the yield investors expected and the yield the Treasury was forced to offer. The larger the tail, the more investors are pushing back, demanding higher returns to lend their money. Several auctions this summer saw unusually wide tails, suggesting hesitation from some of the biggest players in the market. These patterns matter. For decades, U.S. Treasuries have been treated as the ultimate safe asset, stable, liquid, and immune to sudden shocks. But now, bouts of volatility are creeping in. Perception is everything in finance. If enough investors begin to question the safety of treasuries, that skepticism alone can raise borrowing costs across the system. Higher yields on government debt spill over into mortgages, corporate loans, and virtually every financial product tied to treasury benchmarks. The cracks are already spreading, and confidence is draining away one auction at a time. Once faith in treasuries slips, the dollar's dominance may follow. And history shows global power doesn't wait for anyone. So ask yourself, if the pillars of America's financial power are weakening, what does the next global reserve system look like? And who will control it? Subscribe now and stay with us, because the next chapter of this story could arrive faster than anyone expects.